Hello everyone. Welcome back to my channel. In today's video, we are bringing you the topic that explains and analyzes how fintech companies make money. In case you are new here, like and subscribe to this channel. And let's get started. The fintech industry makes money in many different ways. For the most part, fintech's methods take an innovative approach to traditional financial business models. Fintech business models add a layer of expanded financial access, capability, and freedom, providing compelling new experiences that draw consumers in. How fintech makes money: 9 leading fintech business models. Please note that there are hundreds of ways that fintech companies make money. This article aims to explain the most popular methods, but there are always going to be lesser known, or even brand new and undiscovered, ways that fintech companies are able to generate revenue. The following are 9 of the most popular business models that fintech companies use to make money. 1. Interchange fees. When a credit or debit card is swiped, the merchant is charged a percentage of the transaction in fees. Typically, this number is around 3% but varies depending on several factors like card network, Visa, MasterCard, etc., merchant category, and purchase size. This is much more expensive than other payment rails like ARC or Cash, but merchants tolerate this fee from companies like Visa and MasterCard because the transaction instantly settles, providing peace of mind that they are indeed getting paid for these cashless transactions. Around half the card swipe fees, or 1.5% of the total transaction, goes to interchange fees, that, mostly, go to the card issuer. In the case of fintechs, card-providing companies like Chime and Varo in the B2C space and Ramp and Divvy in the B2B space all earn money on interchange fees. In fact, it's the main revenue driver for fintech companies that offer debit cards. That's why many of these companies are able to operate at no charge to their customers. Divvy, for example, doesn't charge customers anything for as many corporate cards as they want. The business model is to attract customers with the best cards and features so they can capture the most spending, and generate the most interchange revenue. 2. Subscription fees. As a tried and true business model in the tech and software industry, subscription fees have been around for decades. Commonly referred to as SaaS, software as a service, companies using this model charge monthly or yearly subscription fees to their customers on a recurring basis in order for them to use their product. This is a common revenue driver for software products in the fintech industry. One area subscription fees are prevalent is with personal financial management apps that help people save, create a budget, or make any kind of financial plan. Some of these apps offer a freemium model where some features are included for free, but users must pay a subscription fee to unlock more features. Examples in the fintech industry include YNAB, Tiller, and Cube Money. 3. Payment processing and funds transfer fees. When money moves, either from a consumer to a merchant or from a friend to a friend, there's often a fee involved. Fintech companies have found countless ways to build businesses around these fees, while adding convenience and even making the fees cheaper in some instances. While there are many different types of payment and funds transfer fees, we'll focus on a couple of the most popular ones here. Credit card processing fees. When a merchant uses fintech companies like Square or Stripe to accept credit card payments, they pay around 3% of the transaction in fees. Square, for example, charges 2.9% plus 30 cents on each online credit card transaction. Some of these fees go to the issuing bank as interchange fees, mentioned above, another part goes to the card network, usually Visa or MasterCard, and the rest goes to the payment processor, Square or Stripe in this example. The portion of the fee that goes to the payment processor is the processor fees, usually 5 cents, and the acquirer markup fee, around 1%. These transaction fees are the main revenue generator for payment processing companies. Several fintech companies in this category are becoming market leaders as they make adding credit card processing easier for merchants. Square alone generated $4.38 billion in transaction-based revenue in 2021, up 43% from 2020. Trading fees. While some fintech companies are able to avoid charging trading fees, more on that later, many do. For fintech cryptocurrency and stock trading platforms, trading fees are one of the main revenue drivers. The cryptocurrency trading platform and wallet app Coinbase makes money in several ways, with transaction fees being the most obvious one that its users frequently encounter. The app charges trading fees based on a tiered structure, with flat fees ranging from 99 cents to $2.99 for transactions under $200. If a transaction is over $200, then they charge a 1.49% fee for bank account payments or 3.99% for debit cards. 5. API connection fees. Application programming interfaces, APIs, are the backbone of fintech. In a nutshell, they allow different software programs to talk to each other and share data. In the fintech world, financial APIs create connections that foster new and exciting possibilities, including instantly connecting bank accounts to apps for new account funding, securely providing a fintech app with a user's transactions history so the app can offer insights and advice, banking as a service APIs that enable non-financial companies to offer financial services. Some fintech companies, including Plaid, more on this below, make money by charging business customers for using their APIs. Fee structures for companies that provide financial APIs vary, but some examples include charging per API call. This works well in models such as account connection, where new accounts only need to be connected once and the API has done its job. Charging for baseline usage, also known as a platform fee. In this case, the API provider sets up a per API call fee, but with the understanding that their customer will pay a baseline fee no matter how many API calls they make. Charging a percentage fee per transaction. This works in API-based payment use cases. In this case, the API provider facilitates the movement of money and charges their customer a percentage of the total transaction. 6. Advisory fees, robo-advisory fees. Investment companies that run portfolios like mutual funds and hedge funds typically charge a small percentage of the total portfolio in fees, which are known as advisory fees. Fintechs like the automated investment company Wealthfront run the same business model, but instead of a human running the fund, they rely on artificial intelligence, AI, also known as robo-advisors, hence the term robo-advisory fees. With AI advisors rather than humans, they can charge just 0.25% advisory fees, which is just 1/4 of the industry standard of 1%. 7. Third parties, referral fees. A common business model in the fintech world is to bring in customers with free value, then show financial product offers like personal loans and credit cards. If a customer of the free fintech product then signs up for the credit card offer, the fintech company gets paid a referral fee. This is also known as a third-party business model since the fintech company brings in another party to create revenue. Credit Karma is a classic example of this in the fintech world. By offering services like free tax returns and access to credit scores, they're able to draw a high volume of customers to the platform. In exchange for free tax return services, users are sent recommendations for financial services like credit cards. If they see a product they like and move forward with it, Credit Karma gets a referral fee. Many fintechs can make a profit this way because they generate value for their users. If there is enough free value, like free tax returns, customers won't mind being exposed to advertisements for third-party products. 8. Payment for order flow. Ever wonder how fintech stock trading platforms like Robinhood let their users make trades for free? The answer is a process called payment for order flow, PFOF. In PFOF, stock brokerages get paid to send their customers' orders to market makers. Market makers want to buy orders because they can profit from the difference between bid prices from buyers and asking prices from sellers. They usually only pay brokerages fractions of a penny per share, but at a high volume that can add up to a significant source of revenue. Robinhood was able to generate $202 million in transaction-based revenue from PFOF in Q2 2022, which was about 64% of the company's total revenue. Fee-free trading has helped bring a large influx of new investors into the market. 9. Interest. A classic financial business model, interest rates are also a common way fintechs make money. While it's not always the main revenue driver, fintech companies that draw customers in for other services can offer loans that generate interest as an add-on product. Coinbase, for instance, has a program that lets customers borrow up to $1 million against their cryptocurrency holdings and charges a relatively low interest rate of 8.75%. For people who don't want to sell their holdings but want to access some of their profits, this is an alternative way to cash out without letting go. It lets users choose to earn cash back in cryptocurrency instead of dollars. They're inventing new use cases, like Bitcoin lending, that provide consumers with innovative tools to access capital and earn rewards. Note: fintech business models create more financial freedom. Fintech has been successful not just because of how it makes money, but because of the value it provides to consumers. One of the reasons that 88% of US consumers have now adopted fintech is because of the flexibility and freedom it enables. I believe you are impressed with this great informative content. Don't forget to subscribe to the video for more useful information about now or the future. Thanks for watching.